In the world of personal finance, investing, and pretty much anything related to the stock market, there are many terms being used that an average Joe is not so familiar with. If you are new to investing and want to learn how to grow your money or anything similar, you should be very familiar with these terms. In this video, we will go over the investing vocabulary, terms and phrases, and present rough definitions so you can get a basic idea of what each term means. I won't go into detail though. This should help you understand the stock market and any investing or personal finance related book way better. The video description contains all the terms with timestamps, so you can just expand the description and use Ctrl F to find a particular term that you're interested in. Feel free to bookmark the video or save it to watch later and jump back to find terms as needed. Follow-up videos are already in works that will explain these terms in much greater depth, and a playlist will be available in the description below as soon as those start popping up. In the meantime, feel free to ask me anything related to these terms in the comments below. So let's start off, and we'll do so with the very basics. Most people trade their time for money, and afterwards invest the money to achieve financial independence. But what is money? Money is any item or verifiable record that's generally accepted as payment for goods and services and repayment of debts. Today, we most often refer to currency when we think of money, which is a medium of exchange for goods and services in the form of banknotes, coins, digits on a screen, or something similar issued by a government and generally accepted as a method of payment. Most currencies today are fiat currencies, meaning that the currency actually has no intrinsic value, nor is it backed by anything tangible like gold, for example. Fiat currencies don't have actual use value. The value is there because a government maintains its value or because everyone who uses it agrees on its value. Central banks control the value of fiat currencies, but they are still susceptible to inflation. Inflation is the rate at which the general price of goods and services is rising. In other words, your currency loses purchasing power with inflation. Deflation is the opposite. A similar sounding term you might hear thrown around often is stagflation, which most often refers to periods of high inflation combined with slow or no growth and often high unemployment. The Federal Reserve System, or the Fed, is the central banking system of the USA. It regulates interest rates, availability of bank credit, and other monetary policies such as legal reserve requirements for the banks. It's also a lender of last resort for commercial banks. The Fed chairman is appointed by the US President. The federal funds rate is the target interest rate set by the Fed at which commercial banks borrow and lend their excess reserves to each other. This in turn also affects the interest rates that we, consumers, get, including interest rates on bonds and savings accounts. Okay, but how do we use our money to make more money? Most often it's done by investing. Investing is the process of allocating money in the expectation of some benefit in the future. In other words, we invest in assets in order to gain returns in form of interest or simply for capital appreciation. An asset, the way most investors see it, is something that either generally rises in value over time or generates interest for you. In other words, things that make you money. Liabilities, on the other hand, either depreciate, so lose value in time, or have some service and maintenance costs related to them, or both. So there are things that cost you money. Interest is money paid regularly at a set rate for the use of money lent or for delaying the repayment of a debt. Recurring interest payments can generate a steady and predictable stream of income for you. Rate of return is the annual income from an investment expressed as a proportion, usually a percentage, of the original investment. Returns are also usually annualized, meaning that they show change of value over a period of 1 year. A similar sounding term is return on investment, ROI, which is a ratio between net profit and cost of investment over a specified period. It's used to evaluate the efficiency of an investment or to compare similar different investments. It would be hard to mention interest without thinking about compounding. Compound interest is interest calculated on the initial principal, which also includes all the previously accumulated interest. This wonderful phenomenon makes your money grow exponentially to the interest rate. Higher interest rates often offer higher returns, but with higher returns usually also comes higher risk, so one should carefully consider their risk tolerance while investing. Risk tolerance is the degree to which you can tolerate sudden changes in the valuations of your investments. Investors often try to lower the risk with proper asset allocation. Asset allocation is the process of dividing investments among different asset classes and/or different sectors within the classes themselves. Asset classes are investments with similar features. Proper asset allocation should provide sufficient diversification. Diversification aims to maximize returns by investing in different areas that should each react differently to the same event, which might be the case for different asset classes, as the ones with liquidity issues might react slower to any events that impact their price, and the event itself might be irrelevant to others. Liquidity describes the degree to which an asset can be quickly bought or sold in the market at a price reflecting its intrinsic value. Most people invest only for retirement, using plans and accounts available in their country or region. 401ks and IRAs are most common investment options. They might have a different name in your country, but let's go over the US version so you can see what they're about. A 401k is a retirement plan that allows employees of a company to save and invest for their retirement on a tax-deferred basis. Now, employers are allowed to sponsor a 401k for their employees by matching contributions up to a point, but this is optional. You don't owe income taxes on the money contributed until you withdraw it from the account. An IRA, individual retirement account, is an account that allows an individual to save for retirement with tax-free growth or on a tax-deferred basis. If you withdraw money from an IRA before the age of 59 and a half, you'll have to pay an early withdrawal penalty. There are multiple types. Traditional IRA. Contributions are often tax-deductible and withdrawals are taxed as income. Roth IRA. Contributions are made with after-tax money and withdrawals are tax-free. SEP IRA allows an employer to make retirement plan contributions to a traditional IRA in the employee's name. Simple IRA requires the employer to match contributions to the plan whenever an employee makes a contribution. Financial independence, FI, occurs when you have enough passive income to pay all your living expenses for the rest of your life without having to work or depend on others for income. The FIRE movement, Financial Independence Retire Early movement, is a movement whose members' goal is achieving financial independence and/or retiring early. The goal here is to generate enough passive income to cover living expenses or expenses of any desired lifestyle as early as possible in life. The 4% rule states that you can safely withdraw 4% of your portfolio each year in retirement, with chances of you running out of money during a 30-year period being negligible. This is based on historical stock and bond portfolio returns over a 50+ year period. Most people invest in the market and/or real estate to generate the passive income required for early retirement. The term "the market," when mentioned out of context, most often refers either to the stock market itself or its participants. The stock market refers to the collection of markets and exchanges where regular activities of buying, selling, and issuance of shares of publicly held companies takes place. A stock is a form of security that indicates that the holder has proportionate ownership in the issuing company. A stock exchange is a facility where stockbrokers and traders can buy and sell financial instruments. The New York Stock Exchange, NYSE, and NASDAQ are two biggest and most often mentioned ones. To buy and sell financial instruments, you will often need a stockbroker. Over-the-counter OTC off-exchange trading also exists and is done directly between two parties without the supervision of an exchange. A broker executes transactions such as the purchase or sale of stock and other investments to financial market participants, often for a commission or fee. They also sometimes provide financial advice and might manage your investments for you. A mutual fund is made up of a pool of money collected from many investors to invest in securities like stocks, bonds, and other assets. They are operated by professional managers who allocate their assets in an attempt to produce income for the fund's investors. A market index represents a segment of the market. This can be companies separated by industry, by size, by past performance, and so on. It's a passive form of investing that sets rules by which stocks are included, and then tracks the stocks without any interference. Index funds allow you to invest in an index through a mutual fund with a portfolio constructed to match and track the components of a financial market index. An ETF, Exchange Traded Fund, is an index fund that trades like a stock and can be bought and sold much more easily than an index fund. Some of the more popular indexes that you will hear mentioned around often are S&P 500, that tracks 500 large US companies, NASDAQ 100, which consists of the largest non-financial companies listed on the NASDAQ, And Dow Jones Industrial Average, the Dow, that tracks 30 blue chip companies trading on the New York Stock Exchange. Things to pay attention to when picking a fund to invest are expense ratio, which is the total percentage of fund's assets used to cover expenses. An expense ratio of 1% means that each year 1% of the fund's total assets will be used to cover expenses, so naturally the lower the better. Management fees, which are intended to compensate the managers for their time and expertise for selecting stocks and managing the portfolio. Most of the time, they remain the same regardless of the actual performance, so the lower the better. And the turnover ratio, or the percentage of a fund's holdings that have been replaced in a given year. More turnover tends to generate more trading fees, commissions, and taxes, so often the lower the better. Real Estate Investment Trust, REIT, is a company that owns and often even operates income-producing real estate. REITs most often own commercial and/or residential real estate. They can be traded like stocks and often also have high dividend yields due to law of obligations. Equity REITs manage and operate income-producing property. They earn money from rents. Mortgage REITs, or MREITs, lend money to property owners and operate like mortgages or acquire mortgage-backed securities. They earn money from interest on the money lent. Hybrid REITs are a combination of equity and mortgage REITs. They both own property and make loans to real estate owners and operators, so they earn money both from rents and the interest on the money lent. Stock options give an investor right, but not the obligation, to buy and sell stocks at a specific price at a specific date. Puts are bets that a stock will fall, while calls are bets that a stock will rise. Something I often see mixed up with puts are short positions. Short sellers borrow shares of stock from, for example, their brokerage and sell them immediately. Now, since the share is borrowed, they still have to return it, but they sold it, which means they'll have to buy it back later, and hopefully this is gonna be at a lower price that they initially sold it for, and they're gonna profit the difference in that case. Futures are financial contracts obligating the buyer to purchase an asset or the seller to sell an asset at a predetermined date and price. A penny stock refers to a small company's stock that typically trades for less than $5 a share. $1 used to be the dividing line, hence the name. But on many exchanges nowadays, delisting occurs near that price. Delisting is a phenomenon where a security is removed from the exchange on which it trades. On the New York Stock Exchange, for example, if a security's price closes below $1 for 30 consecutive trading days, the delisting process will begin. An IPO, or initial public offering, refers to the process of offering the stock of a company on a public stock exchange for the first time. Forex is the marketplace where national currencies are traded in pairs. Each pair has a price associated to it. For example, if Euro-USD price is 1.109, this means that you need 1.109 US dollars to buy 1 euro. A contract for differences, CFD, is a financial contract that pays the differences in the price between the open and closing trades. In other words, you are betting on the direction of the price movement without buying the underlying asset. Cryptocurrencies are digital currencies that use encryption techniques to regulate generation of currency units and verify the transfers, instead of having a central issuing or regulating authority such as the central bank. Bitcoin is the first decentralized cryptocurrency. Bonds are financial instruments that represent a loan made by an investor to a borrower, most often the government or a company. The owners of bonds are debt holders of the issuer and receive interest payments from the borrower. Bond maturity date is the time at which the loaned funds must be paid back in full. Now, there are many different parameters to look at when considering whether to buy a stock, so let's see what they mean. First off, a stock ticker symbol is an abbreviation used to uniquely identify publicly traded shares of a particular stock on a particular stock market. Candlestick chart, also known as a Japanese chart, uses candlesticks with different colors to show 4 price points: open, close, low, and high, through the specified period. The candle body represents the price range between open and close, and shadows below and above the body show the low and high of the specified period respectively. Now, if the body is red or filled, that means that the candlestick is bearish, open was above close, and if the body is green or empty, that means that the candlestick is bullish, open was below close. Fundamentals are financial information reported in the quarterly or annual statements of the company. Market capitalization is the total dollar market value of a company's outstanding shares. It's often referred to as market cap and can be calculated by multiplying the total number of a company's outstanding shares by the current market price of one single share. Big or large cap companies have a value of more than 10 billion US dollars. Medium caps are between 2 and 10 billion, small caps are between 300 million and 2 billion. Blue chip companies have a long record of stable and reliable growth. They often pay dividends and generally sell high quality, widely accepted products and services. Blue chip companies are known to weather downturns and operate profitably even in the face of bad economic conditions. The price to earnings ratio or PE ratio is a ratio of company's share price to the company's earnings per share. It's most often used to find out whether the company is undervalued or overvalued. Historical average value is around 15 and the lower the better in the most cases. Quick ratio indicates the company's ability to instantly use its near cash assets to pay down its current liabilities. It's also called the acid test ratio. The higher the better. Year-to-date return is the profit or loss realized since the first trading day of the current calendar year. 52-week high or low is the highest and the lowest price at which the stock has traded during the time period of 52 weeks, that's 1 year. Beta measures a stock's volatility compared to the overall market. If a stock moves less than the market, the stock's beta is less than 1 and the other way round. High beta stocks can be riskier but provide higher return potential. VIX is an index that measures expected volatility based on the S&P 500 index options. It provides the expectation of 30-day forward-looking volatility. A dividend is the sum of money paid regularly by a company to its shareholders out of its profits or reserves. It's a fixed amount per share. Dividend yield shows how much a company pays out in dividends each year relative to its stock price. It's expressed as a percentage and the number fluctuates as the stock price and the dividend itself changes. Ex-dividend describes a stock that's trading without the value of the next dividend payment. The ex-dividend date is the date the stock starts trading without the value of its next dividend payment. Investors who purchase the stock before the ex-dividend date are entitled to the next dividend payment while the others are not. A dividend reinvestment plan, DRIP, is a program that allows investors to reinvest their dividends into additional shares or fractional shares of the underlying stock as soon as they receive them. A fractional share is a portion of one full share. Valuations of independent stocks as well as the market in general tend to go up and down over time. Market cycles are the long-term price patterns of stock market and are often tied to the general business cycles. Recession is a period of 2 or more consecutive quarters of economic decline. It's often accompanied by a bear market. A bear market is a market condition in which share prices are expecting prolonged price declines, encouraging even more selling. A bull market is the opposite, a market condition in which share prices are increasing. Market return is defined as the return of the overall market portfolio, which includes all assets and having the portfolio weighted for value. We most often refer to returns generated by S&P 500 or the Dow or something similar as market returns. A growth stock is a stock that's generated better returns than the market over a certain period. Now, it's very important to differentiate investing from trading. Investors aim to invest for the long term, while traders buy and sell stocks frequently, sometimes even multiple times a day, in hopes of realizing small gains that pile up. Dollar cost averaging refers to investing a set amount of money at fixed intervals, regardless of price. For example, investing $1,000 every 15th of the month, every Friday, every quarter, and so on. Buy and hold is an investment strategy that focuses on buying securities and holding them for literally decades, thus relying on compounding to speed up the growth. Investors often use dollar cost averaging to invest in the long term. Dividend growth investing is a strategy that aims for dividend income and capital appreciation. Investors select companies that have a good track record of increasing their dividends over the years. Value investing is a strategy that focuses on finding undervalued companies and investing in them with a margin of safety. Price and value are not always the same. They can be very disconnected, and value investors make use of this. Active trading is the act of buying and selling securities based on short-term movements in hopes of profits. Bear in mind that market timing is very difficult. Less than 5% of those who attempt it have any reasonable success at it, and less than 1% have good long-term returns. Market timing involves trying to buy securities while the price is low and selling when it's high. The problem is that nobody can see the future, so this backfires very easily. Thank you for watching, that's gonna be all for the video. As I already mentioned, the videos with more detailed explanations are in the making and will pop up on the channel over the coming months. The playlist link will be available in the description below. As a final note, let me just clarify that none of this is any kind of investment advice. Do your own due diligence before investing, and you and only you are responsible for your own actions. With that out of the way, I really hope this video helped you, because it took like ages to make. If you found it useful, make sure to share it with a friend so they can also learn these terms. Feel free to leave a like and subscribe with the notifications turned on so you don't miss the upcoming videos. I'll see you again soon, so enjoy the rest of your day. Bye bye!